Good morning, everyone. Mike and Corey here today on a nice Thursday. Exciting topics continue: tariffs, Ukraine, all federal DOGE or DOGE, Department of Government Efficiency. All of this in the news. So today we're going to talk about, or I'm going to start off with talking about some of the government layoffs and the impacts downstream. I'm going to do a quick comparison of the S&P 500 growth stocks versus value stocks. And then Corey, in an attempt to grow a mustache, is going to talk about what is it called? Mean Mr. Mustache? No. Mr. Mustache?
Yeah, Mr. Money Mustache.
Mr. Money Mustache. So he, we'll have to have Corey grow a mustache so he can be a lot more like Mr. Money Mustache. Is there a Mr. Money goatee? I used to have a goatee. Maybe that could be my
It's
identity.
a whole, well, it's a pun. It's like my stash.
I see. Jeez, I didn't get it.
Yeah.
My goatee. I don't know. Well, I'll think about that later. I'll have to think about it. That's right on the fly here. So, as we get started, this is a financial education presentation. You must do your own due diligence on anything you hear in this presentation. More disclaimer information can be found on ankerstarwealth.com, and the opinions are expressed are mine and Corey's alone. Although Corey's gonna give us the money mustache impression. So. With that here, I'm going to start off and I'll take us over and we'll look at what the market's doing today. Just a quick glance. It's in the red. Yesterday was a nice bounce back day. Today it's not lost all those gains from yesterday, but it's certainly down. We don't like to hear that. Says traders, it slides on awaiting more clarity on Canada and Mexico tariffs. Well, I hate to say it, we're not going to have clarity into that for a while. It's going to take some time to work out. I've talked a lot on tariffs, so I'm not going to focus on that today, but it is in the news. It's top of mind. One thing that is in the news that we're hearing a lot is layoffs, and layoffs from the government as the Department of Government Efficiency, Elon Musk, his group, lays off federal staff. And I listened to some different podcasts on this yesterday. And I'm not going to be able to quote the exact numbers, but I think there's 3 million federal employees. If they cut 10% of them, that's 300,000, or it's a number like that. And overall, that kind of number is 0.2% of the employment. So, in a sense, that's not a huge number, 0.2%. But what I was listening to yesterday it stressed there's more importance to that than we think. So when you hear layoffs and you hear government layoffs and we hear this, what it does is it hurts consumer confidence. Like, while you or I may not be laid off today, but we hear others, and it's in the news all the time, it creates concern. It causes us to lose confidence, which means maybe we pull back on our spending, maybe we pull back on our investing. So there's a downstream effect. That's the psychological effect. The other effect is these government employees that, some of them, let's just say, some of them were doing things that were useful, and maybe some were not, but we won't go into that part of it. But what this can cause is the government is like a funnel. So think of it like this: the funnel of money from taxpayers comes into that big end, and it aggregates to a lot of dollars, and then the government spends them out, pushes them out. Some go to military, some go to Medicaid, some go Social Security. A lot goes to the states. And then so if they hurt the funnel, if they stop this apparatus from putting the money out, guess what? All those downstream entities are impacted. And the ones I was listening to yesterday had a lot to do with the state. So maybe there's only 3 million federal employees, but I think they said 20 million. There's a lot more that are at the state level. And if funds are impacted, guess what? They may experience layoffs, and it goes downstream. So this is a concern. some of these are going to be, voluntary retirements, early payouts, things like that. And then some, whether it gets to the point of they didn't turn in what they're doing this week, they get fired kind of thing. I hope it doesn't come to that. But I want to here's an example of a downstream effect. Trump goes after education. Let's not worry about the title, but education department, it may impact student loan borrowers. So people have valid student loan needs, but if the people aren't there to process the student loans, they don't get the dollars. The dollars are still sitting out somewhere on the Fed Treasury book or somewhere. They're sitting out there, but they don't get it. So therefore, they can't pay to go to college. So the college gets impacted, the student gets impacted, and this is the downstream effect. This is why this early time when things are very volatile, it's not as easy as, hey, we just cut employees and we save dollars and there's no impact. There is an impact, and so I just wanted to kind of state that, and that's what we're listening, learning from, watching what happens within the markets. Okay, so that's one topic. Corey, what do you think about that? I impacted yet? Maybe your BMB lines go up. I don't know.
I gotta mention what Warren Buffett said in his recent interview a couple of days ago. With economics, the only question that matters is, and then what? So what we don't know all the dominoes that stand behind some of these decisions, but that's what we're thinking of, and that's what obviously economists are doing as well.
Yep. So interesting things happening there that is impacting the markets. The other thing I wanted to talk about today is I want to talk about growth stocks versus value stocks. So your growth stocks are it's going to be the Apples, Nvidias, Meta, exciting stocks that are growing rapidly. Their prices tend to go up. Apple makes big profits, but they don't tend to bring in lots and lots of profits. They usually don't pay a dividend, or they pay a very tiny dividend in respect to the price, as opposed to a value stock like a P&G or Coca-Cola or AT&T. They bring in cash and they pay it out in the form of dividends. And what I'm showing here on the screen is a 1-year graph. The green line is the growth stocks, and the blue line is the value stocks. So if you were investing from a year ago and you say, wow, growth stocks are up 19%, value stocks are up 7%, although they pay a dividend, so it's a little bit higher than that. They might pay an average of a 2 or 3% dividend, so they might really be up 10%. And you'd say, wow, this is easy. I should invest in growth, right? It's like, makes sense. Growth, you can see it's certainly more volatile. It goes up, it comes down a lot faster. And if I pull back and I look at a 5-year chart, there you go, 111% or 68% growth, doing pretty good. Now I'm going to pull back and say, let's look at year to date. So year to date, growth stocks are down 4%. And value stocks are up 1%, or basically flat, plus they pay a little bit more of a dividend. So in this glance, you'd say, wow, if I was just looking at year to date after a couple months, value is outperforming growth. And that is true. The question is, will it continue? Certainly our models have been overweight growth, which when I pull back to 5 years, or I don't even know, I'll pick all, let's see what that takes us back. You pull back to all, it takes us back to 2001. You can see that it's been good to be in growth since 2001, although actually you can see value did pretty well up until the crossover point was 2008.
The pandemic.
Well, 2018, there was a crossover, and you're right. And then since the pandemic, growth has done much better. So let me go back to the year to date. So what does this mean? There's a couple ways to look at this, and this will lead into Corey's talk. Growth stocks tend to be more expensive as far as PE ratio. When they look at earnings and price to earnings, they're more expensive. At some point, growth gets too expensive. It's like, I don't really think this is worth it. Yeah, I mean, yes, there will always be some that, come out of nowhere and you're like, wow, I really wish I'd invested in them. But as an overall S&P 500, it says, wow, they're too expensive and we should shift more dollars to value stocks. And that's what we evaluate within our portfolio. Is this a trend that will continue, or will it go back to, let's just say, the last 5 years or the last 1 year and say growth out? It could be from here that growth does great. We don't know yet. Um, a big part of that has to do with interest rates too. As interest rates come down, money is less expensive to borrow, and growth companies, they tend to borrow money to invest in projects, where value stocks are less likely because they have plenty of cash anyways. Or I shouldn't say they have cash, but they pay out to the dividends. So just a concept to look at. I don't know. Corey, what do you think?
Some people, it can be a personality thing too. Some people are, because you can make money in both, and it just depends on, as Steve mentioned, sometimes what kind of roller coaster do you want to be on, and you can pick, right, and you can do okay in both. On the growth, one of the reasons that the growth stocks are more volatile is because they are harder to value. You could imagine valuing a Palantir versus a Coca-Cola. The math is much simpler on a mature, boring, consumer packaged goods company, or like a Coca-Cola. So that's one of the reasons that the stock prices are more volatile, is because the businesses are just harder to value, and they change quickly.
Yeah. Yep. Okay, I'm going to stop sharing my screen and Corey can take it from here.
All right. And so hopping over, I saw that we mentioned Mr. Money Mustache a couple of weeks ago, and I said I'd come back to him at some point, and I saw that he had a new article out. So, wow, have you seen the stock market lately? We certainly have. He published this on February 25th. So the S&P was right around 600 when he published it. So just interesting. But he starts off talking about, the last 2 years, the market has been up 57%, of course, as of the date this was published, and has more than doubled in the past 5 years. He talks about how if you were a person who was approaching retirement, you have probably blown past, your retirement goal. Mike, I did have a question. Oh, I was looking at the wrong tab. Mike, did you, when you were, younger, starting your investing journey, did you have like a number that you were if I could just get this, I'd be there, I'd be at the finish line?
Well, I mean, back when I was in my 20s, back when you just had paper and you didn't have any. No, I'm just kidding. But it used to be that $1 million was always that retirement goal. If I had $1 million in my retirement account, and then of course you use that 4% rule. I could draw 4% out per year and keep it there. That was always that kind of nice goal to think about. I can't remember back to my 20s. Of course, when you're making, I want to say, at one point I was making $3.35 an hour minimum wage and $11 an hour for an internship. $1 million sounds pretty good.
Yeah,
Nowadays, I'm not sure $1 million's what it used to be, especially with the cost of healthcare.
no kidding. Well, that's always an interesting question. And to Mike's point, for many investors out there, when you get to that number you had set out for yourself, you might all feel like, well, I need a few more years, or maybe a few more millions, depending on how your life has changed in that time. So he talks about this. I love. I love this analogy. He talks about how stocks are like rental properties, and I like this too because I have some clients and talk with people who also own rental properties. And part of the draw for investing in equities is it's almost like building another, sometimes even much larger rental property, but instead of buying an entire property at once, you kind of build it brick by brick by brick, month after month after month. And that rental property or that asset should be in some ways, at least an income producing asset that's providing you a growing stream of, depending on who you talk to, but a passive income, depending on how people define that. I'm fine calling it passive income. So when you get that mindset, it's, if the value of my rental house goes down 10%, I'm probably not selling. The rent is most likely staying the same or very close. And same thing with a portfolio of stocks that you can view as like a big rental house. If the value of that portfolio of stocks has fallen by 10%, that income stream that you're generating from that asset should be the same or possibly even growing. So I like that analogy. That's pretty cool. Now, then he starts to tackle, are we kind of in a bubble? He looks at these valuations. He does compare earnings growth of the Mag 7, which is very high, and earnings growth of the S&P without the Mag 7, which is mid-single digits. Honestly, combine that with the dividend, that's very fair and competitive, and the economy's been good. He talks about how the S&P is made up 25% or more of those Mag 7 stocks, and they do have those higher valuations, but they are growing quickly. That's an interesting dynamic. So it is justified. Whereas sometimes in the past, some of those higher valuation companies weren't as justified. He does talk about, where does this bring in artificial intelligence? So he talks about how the Mag 7 are falling over themselves, building those massive data centers, trying to capitalize on the AI boom, and how and how most of the Mag 7 are funding it, and then of course NVIDIA is scooping up all of that revenue. He talks about how AI is sort of expected to benefit all other industries as well. And he says, so this is his claim, having followed the field for a while, he thinks it will come true. So he thinks that margins for many, if not most, or all S&P 500 companies will increase because of the AI boom. And because of AI. He doesn't know for sure, though. Did he show the other valuations? I can't remember. He mentions that the other S&P 500 companies have a PE ratio of about 20 compared to the Mag 7, which is average of 45. So that's what he mentioned. I guess there was no chart for that. Yeah. That kind of brings us to the end of this, his prediction and all that. What should we do about it? He mentions that we don't know for sure how it'll play out. But what he does mention is that regardless of how it plays out, being a long-term investor is in your benefit. He points to this blue line. If growth continues at this level in the stock market, you're going to get massive returns from here. Then the yellow line. What if you have a normal path and you invest those dividends? I think that's what that line means. And then the last one is the normal path, including dividends.
Interesting.
Current path, including dividend. So what he's really trying to paint the picture is here. The picture here is that being a long-term investor is to your benefit, regardless of how those growth rates actually play out. So anyway, interesting stuff, Mike, and I'll send it back to you.
Yeah. So I like hearing different perspectives, people out. I haven't read a lot of Mr. Money Mustache's blogs. I'm familiar with his impact on the FIRE movement, which involves retiring early, and so I would almost feel like he would be a conservative guy, like very conservative investing, but it doesn't sound like it. It sounds like he's open to all concepts, but certainly being a long-term investor is key. I love how he brings up the part about the rental income. So when you buy it, if you were to buy houses and you say, I'm going to buy houses because I want to get rent and income from them, that's one angle. In most people, that's the way they do it. But there are some that say, I'm going to buy a house because I think this area is going up in value, and my plan is to flip it. So I'm not planning on making a lot of money off of rent. I'm planning on sell it more than I bought it for. That's more along the idea of the growth mindset. So it's kind of like, what would you do if you were going to buy houses? Are you buying houses for rental income, or are you buying houses to flip them and make more money? It might be a hint to what your investing strategy is as well.
That's cool, Mike. That's a great point. I hadn't thought of that.
Well, we will continue to monitor. I do not expect tariff volatility to be removed by the end of the day. I think it's going to take a while. That is primarily what's causing a lot of the market gyrations. It does provide opportunities for new money to come in and be invested at things on sale. I like that for new clients or clients adding. For those of you that are like, oh, I'm already in, yep, this is the roller coaster ride. It's just the way it is. And, if you have any questions at all, concerns, please contact one of us or your advisor, and we'll be more than willing to talk through it. Make sure you're in the appropriate risk model that you should be. That's all we got. Thank you. Bye.